welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth. And again this week, I'm delighted to be joined by Tom Hibbert, our Chief Investment Strategist from our Chief Investment Office.
Hi everyone, good to be back.
Welcome. And as you know, each week we try to cut through the noise and demystify what's going on in the markets in a simple and easy to understand manner. So then you can feel more informed, more confident, and more in control of your financial future. So this week, Tom, I want to have a little look back on April, because now we're the beginning of May, and understand why markets surged really during April and why this actually matters for long-term investors and what that all means.
Sure.
So grab your coffee and let's dive on in. So April was the strongest month for markets since late 2020, I think you said.
Yeah.
With global equities up 10.15% to be precise in April. So what has changed after the wobbles we saw in March? And is this mainly about corporate earnings or is it something broader?
Yeah, I mean, you'll note that in this podcast, we're not going to talk about the conflict in the Middle East.
For a change.
And I think for a change, and I think that's actually one of the key components because markets have really started to look through that energy shock and all of the tensions there and focus much more on the fundamentals.
Yep.
And the fundamental picture has been incredibly solid. And that has really shone bright in April as companies have reported earnings, particularly in the US. So it's the US where companies have reported so well and the US has led the charge for global equity markets. There's also been broader earnings strength. Okay. So we've had about 50% of companies report now in the US. We're on track for a sixth consecutive quarter of double-digit earnings growth.
Right.
Analysts are still forecasting really solid earnings growth, so up to over 21% for the next 12 months, which is really quite remarkable strength.
That does sound impressive. So how unusual is that then?
Yeah, it's quite unusual to have six consecutive quarters. I mean, double-digit growth is really solid.
Right.
To have six consecutive quarters of such strong growth is really quite remarkable. And it's not just that. I mean, you're seeing record profit margins. Companies are beating. I mean, all five of the Magnificent Seven companies that reported last week beat on both earnings and revenues. Yeah. So remarkable strength across the board, but with the sort of mega cap tech stocks leading as the brightest lights. And we've seen broad-based earnings, but the focus last week was on particularly some of the tech-related mega cap stocks, sometimes called the Magnificent Seven.
The Magnificent Seven. Okay, so who is in the Magnificent Seven? What are those companies?
So the five of the seven reported last week.
Yep.
Alphabet would be one of the key ones, had really strong results and bounced. That's Google. Yeah, parent company of Google. Yep. Meta, another one that reported.
And what's that? Facebook, Instagram.
Exactly. Yeah. So those are the two key sort of drivers within the Magnificent Seven last week. You've got Nvidia in there, which didn't report last week, but that's obviously been one of the market darlings of the last couple of years.
So is this still all about AI excitement then? We've talked about that on the podcast in the past. Or are investors sort of seeing through that excitement and becoming a bit more demanding about costs and profitability, hence the earnings coming through?
Yeah, and we've seen quite a lot of dispersion start to arise within the tech sector. Yeah. This cycle is still really all about tech and driven by tech, and within that particularly about AI and the revolution of the tech sector and the broader global economy driven by artificial intelligence. But we are now seeing greater focus within those tech darlings on the amount of capital expenditure, how much that capital expenditure is leading through to AI demand for these large language models, how much business is it generating relative to the amount of expenses and investments that these companies are making at the same time. So a more scrupulous approach to how markets are reacting to these results.
Okay, thank you. So let's talk about central banks. And last week, there were a total of 10 central bank meetings, including the Fed in the US, the European Central Bank, the Bank of England, and the Bank of Japan. So 10 central bank meetings all in 1 week sounds...
Busy week.
Sounds busy and dramatic.
Yeah.
And I know you love a central bank meeting.
I do.
Yet the markets barely reacted. So why was it so quiet?
Yeah, this half of the podcast risks being a little bit boring because
never.
there weren't really any surprises. But, all of these central banks fundamentally face renewed inflation challenges. The key question is how much inflation is coming down the pipeline from this energy shock.
Yep.
And how will central banks respond to that? Now, the UK, Europe, Asian central banks, the Bank of Japan, they're all more sensitive. Those economies are more sensitive to this energy shock than the US. So the US has a bit more flexibility.
Because the US has got its own energy
exactly,
supply.
Yeah. It
can pump its own oil.
It's a little more insulated from the shock.
Yeah.
The market still expects the Federal Reserve at the margins to cut rates, whereas the market's expecting interest rate hikes, particularly in Europe from the European Central Bank and the UK. The question is, the UK and Eurozone have weaker economies. Those economies are slowing.
Yeah.
And the transmission effect then from this energy shock is more difficult it's less clear for it to transition from a supply side shock into the demand side, into wage growth, and companies might struggle more to pass on rising prices to consumers. So with that less clear, maybe those central banks will still be more hesitant to hike interest rates, but that's what the market is expecting. And both of those central banks, they spoke about their flexibility to, if potentially raising interest rates, if there are signs of inflation transmitting away from just the energy shock into more core inflation, into goods prices and wages. And I think that is still a key concern that central banks are going to be watching very carefully. Yeah, but no surprises there.
Hence, not massive market reaction.
Not massive market reaction. The bigger surprise was in the US, actually, which is more insulated from the shock, the Federal Reserve, where, this was the last meeting with Jerome Powell as the chair. And it was also the one meeting during his chairmanship which saw the most dissent in terms of, not actually in terms of voting against the decision to hold rates, but they left in the statement that they released with the decision a sentence that still showed an easing bias, that they were more inclined to cut interest rates than raise interest rates. Right. And there were 3 members of the committee that opposed the inclusion of that statement, which is quite unusual. So the implication
of that for rates and for investors,
it was seen as more hawkish, which means that the Federal Reserve, actually, the market sees them as still cutting rates. Maybe they are more inclined to hike interest rates.
Okay.
So that was a little bit of a hawkish surprise out of the meeting. And it's a bit of a sour note for Powell to end his chairmanship on.
But he's going to still stay on the board, isn't he?
Yeah, good point. He is. He's staying on the Board of Governors for an unspecified period, and he cited the political interference worries that the Federal Reserve is under too much pressure from the US administration to cut interest rates. So he's decided to stay on, citing that political interference as his reason. And
what do you think? Remaining. Do you think
that's pretty unusual?
Political pressure on central banks could become a bigger market issue over the next few years?
The market has made it quite a big issue. I'm not as concerned as the market about it. I really like Kevin Warsh as a replacement.
He's the new incoming chairman of the Fed.
Exactly. I really do rate him. I agree with a lot of his views on Fed policy in recent years. I think he's a very good replacement. I don't see any evidence that he will, act as a puppet of the administration. He might have some views that share a lot of the views of the administration, but
that's a different thing.
That's not an issue by itself. So and the Fed will still remain a committee with committee-led decisions. I think injecting a little difference of opinion is actually probably a healthy thing into the Federal Reserve. So I think it's a bit of a red herring, the whole political interference thing.
So if you had to boil all of this down, just thinking about our clients and long-term investors, what should they be focusing on the most? Is it earnings? Is it rates? Is it geopolitics?
Yeah, everything altogether really is important.
Sit on that fence.
But yeah, sit on the fence. I'll try and be more opinionated. Look, I think earnings have been a real highlight, and it just shows how the strength of the corporate landscape that underlies the investment environment that we're in at the moment. Yeah. Yes, there's a lot to be that you can get worried about, but fundamentally, when you look through all of that fog, there's a really solid backdrop. The question for me, the key question, is to what extent is that fundamental strength reflected in valuations? And markets are quite expensive, so you're paying up for that quality.
Okay. Yeah, all right, understood. Okay, well, I think it's probably time for me to sum up what is in my Canaccord takeaway coffee cup this week. So April's rally was driven by the fundamentals we just talked about, earnings led, and not just by excitement, not people just getting carried away with the markets. US earnings growth in particular is very strong. We talked about AI investment, particularly with the headline tech names, the Magnificent Seven, but probably broadening out a little bit as well.
Yeah, well, the focus is shifting. It's becoming more scrupulous in terms of investors really need to start seeing the returns on that investment.
Yeah. And while inflation is still a concern, the central banks have been talking about that, they are treading carefully as growth outside the US cools, so just keeping an eye on that one. So for long-term investors, I think it's the same message as we say most weeks. Stay anchored in earnings, really, and quality. Keep diversified, and perhaps don't let all the short-term noise distract from some of the long-term opportunity that we're seeing.
Precisely that.
So thank you so much for listening to the Canaccord Coffee Break podcast. We do appreciate it. If you've enjoyed it, don't forget to hit follow on Spotify or Apple or your podcast channel of choice, and then you will never miss an episode. And as always, we'd love to hear your thoughts. Drop us a line, ask us questions. coffeebreak@canaccord.com.
And you have a break from me next week. You've got the excellent Leo Bramwell back on the podcast.
Marvellous.
So
lovely.
Everyone will be glad to hear that.
Thank you very much.
Thank you.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.